Hi everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to explain why I think Amazon stock is still undervalued now, based on Amazon's long-term growth prospects in artificial intelligence, cloud computing, advertising, and e-commerce. As you may already know, Amazon is one of the best performing stocks this year. For example, at the time of making this video, Amazon stock has already recovered more than 50% year to date and is still beating the S&P 500 by a very large margin this year. This may surprise you. In the past 5 years, Amazon actually underperformed the S&P 500 due to overexpansion during the pandemic, overhiring of employees, and the overexpansion of fulfillment networks and warehouse capacity. But in the past 10 years, Amazon still outperformed the S&P 500 by a very large margin. In the past several quarters, Amazon had to lay off thousands of employees and cut down its expenses to become more efficient. As of now, Amazon's businesses have recovered a lot since the bottom in 2022. The latest quarterly operating income here shows that Amazon has recovered a lot this year. If you're an Amazon investor, you will want to know, will Amazon's growth accelerate again and achieve double-digit growth going forward? So in this video, I'm going to talk about why I think Amazon is still undervalued now, based on Amazon's long-term growth prospects in AI, cloud computing, advertising, and e-commerce. You will learn about these topics in this video: Amazon's financial overview, Amazon's biggest risk you should know, Amazon's long-term growth prospects, Amazon stock valuation, and will I buy Amazon stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculators for all the stocks I'm analyzing. So you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Amazon's long-term growth prospects, I want to share with you Amazon's most recent financials. This will help you have a better understanding of Amazon's business model and help you understand how Amazon earns its revenues, operating income, and free cash flow every quarter. Amazon is much more than its online retail store and online marketplace. Amazon has these 6 major businesses: online stores, physical stores, third-party seller services, subscription services, advertising services, and Amazon Web Services, AWS. Amazon also has other bets and investments here, but we're not going to talk about them in this video. This is because these other bets are not contributing a large amount of revenue to Amazon yet. Here, you can see that Amazon's online stores and third-party seller services contribute the most revenue to Amazon. AWS and advertising services also contribute a lot of revenue to Amazon. According to the latest quarter here, online stores and physical stores have been growing much more slowly compared to other businesses. They're only growing single digits each quarter. In comparison, third-party seller services, subscription services, advertising business, and AWS all have double-digit growth rates. Even if Amazon's online stores and physical stores continue to have very low single-digit growth rates, I believe Amazon's third-party seller services, subscription services, advertising business, and Amazon Web Services (AWS) will continue to drive Amazon's revenue growth going forward. I will talk more about Amazon's expected long-term growth rates later on in this video. Amazon reports its sales in these 3 segments: the North American market, the international market, and Amazon Web Services (AWS). If you look at these financials here, you can see that the North American market is a profitable business again after recovering from large operating losses in 2022. The most recent quarter's operating margin is only 3.9%, which is very low. This shows that most of Amazon's businesses have very low operating margins, or they're not profitable yet. Amazon's international market is not profitable yet. The most recent quarter's operating margin is negative 3%. Just to compare, it took Amazon 9 years to make the first profit. I think Amazon's international market will eventually become profitable with a very low operating margin, similar to the North America segment. But the international market will need more time to become profitable. Amazon's most important business is its cloud computing business, AWS. This is Amazon's most profitable business. According to these financials, AWS contributes the most operating income every quarter. AWS operating margin is 24% in the most recent quarter here. This is much higher than all other Amazon businesses. In fact, AWS contributed almost 70% of the company's operating income in the recent quarter. One of Amazon's most important goals is to generate sustainable long-term free cash flows. Amazon's actual free cash flow is much lower than what is shown here. This is because this standard free cash flow does not take into Amazon's large capital lease payments every year. Let me explain here. Every quarter, Amazon gives investors these 3 free cash flow calculations, which can be very confusing if you don't understand accounting. First is the standard free cash flow, which is operating cash flow minus capex. Second is free cash flow less principal repayments of finance leases and financing obligations. In my opinion, this is a much better representation of Amazon's actual free cash flow every quarter. You can see this free cash flow is much smaller than the standard free cash flow. And third is free cash flow less equipment finance leases and principal repayments of other finance leases. The standard free cash flow overstates Amazon's actual free cash flow every quarter. This because it does not minus the large capital lease payments every quarter, so I wouldn't use the standard free cash flow when I'm analyzing Amazon. Again, I think the second free cash flow calculation here is a much better representation of Amazon's actual free cash flow every quarter. Let's talk about Amazon's biggest risk here. The first risk we should consider is this. For years, Amazon has been spending a lot of money to buy out businesses that have large potential, but most of them are still not profitable. Most of these large acquisitions will likely fail over the long run because they cannot continue losing more money every year. At the time of making this video, Amazon is looking for the next business or the fourth pillar that will drive Amazon's long-term growth going forward. As of now, Amazon has 3 major pillars that are driving the company's revenue growth. These 3 major pillars are Amazon's online retail marketplace, which includes third-party seller services, Amazon's subscription services, which include Amazon Prime, and Amazon's cloud computing business, AWS. These 3 major pillars account for almost 90% of the company's total sales. According to the Wall Street Journal, Amazon has been making big bets on other businesses, such as healthcare, entertainment, and hardware, but most of these new businesses and acquisitions are still losing a lot of money. Most of these large acquisitions are not making profits for Amazon yet. Amazon has been making huge bets on healthcare businesses in recent years. Here, you can see that Amazon's one medical business has been losing more money every year. If I'm a long-term Amazon investor, I wouldn't be happy about Amazon's capital allocation strategy. Amazon's current strategy is to buy out many businesses, such as Whole Foods, MGM Holdings, One Medical, and iRobot, or invest in companies such as Rivian, which may become the fourth pillar business for Amazon years later. However, this strategy has a very low return on invested capital, and the risk is high. Many of these businesses will likely fail because they cannot continue having large losses every year. Amazon is essentially betting that some of these companies will become very profitable later on, which may or may not happen at all. In my opinion, I think it's much better if Amazon invests more in the current businesses that are already profitable than trying to build a fourth pillar and spending too much money to buy out other businesses that are not profitable yet. Here is another risk we should consider. At the time of making this video, many large enterprise customers are still optimizing their cloud spending on AWS because there are still many macro uncertainties such as higher inflation, higher interest rates that will likely stay longer than expected, lower demand in the PC sales market, and slower economic recovery in China. Many AWS customers are still looking for ways to reduce their cloud spending because they're concerned about the overall economy and how that will impact their businesses. For example, just before making this video, the Fed decided to hold its interest rate. The Fed is still planning to have one more rate hike this year. More importantly, the Fed is planning to hold higher interest rates longer than expected in 2024 in order to force inflation back to the 2% target. Of course, holding high interest rates longer than expected affects the overall economy. It increases borrowing costs for businesses and consumers, discourages business spending, and decreases consumer spending. In my opinion, all these macro headwinds will likely cause more AWS customers to continue optimizing their cloud spending on AWS over the next several quarters. Because of all the macro headwinds now, you can see that AWS revenue growth has decelerated a lot in the most recent quarters here. Going forward, we shouldn't expect AWS to have the same high revenue growth rates as before. I believe AWS revenue growth will accelerate again once there are fewer macro headwinds affecting AWS customers' cloud spending. In terms of long-term prospects, I believe several growth drivers will help Amazon return to double-digit growth rates going forward. I want to focus on the two most profitable businesses here, AWS and advertising. I believe these two businesses will drive Amazon's operating income growth going forward. The first biggest growth driver is AWS. This from the most recent earnings call. Amazon has been able to reduce fulfillment networks' operating costs and therefore improve Amazon's operating margin after switching to more regional warehouses and fulfillment centers, and after reducing expenses by laying off thousands of employees in the past several quarters. Second, AWS growth seems to have stabilized and bottomed after AWS customers started optimizing their cloud spending last year. More importantly, many large AWS customers are shifting their focus from cost optimization to more new workload deployment that will drive more growth going forward. For example, many AWS customers are investing in AWS to build their AI models, build their large language models using Amazon's custom AI chips, and create their generative AI applications. I think this is a very important cloud spending shift. This shows that many AWS customers are now ready to spend more money on AWS because of the large demand for generative AI that will likely transform many industries. Management said this in the most recent earnings call. And while customers have continued to optimize during the second quarter, we have started seeing more customers shift their focus towards driving innovation and bringing new workloads to the cloud. As a result, we have seen AWS revenue growth rate stabilize during Q2, where we reported 12% year-over-year growth. What we are seeing in the quarter is that those cost optimizations, while still going on, are moderating, and many may be behind us in some of our large customers. And now we're seeing more progression into new workloads, new business. So those balance out in Q2. We're not going to give segment guidance for Q3, but what I would add is that we saw Q2 trends continue into July. So generally feel the business has stabilized, and we're looking forward to the back end of the year in the future. Because as Andy said, there's a lot of new functionality coming out, and there's a lot of spend that will be in this area for all the great solutions that are out there for generative AI and large language models, as well as machine learning solutions that we have always had for customers. So optimistic and starting to see some good traction with our customers' new volumes. As of now, there's a very large demand for generative AI and services that can help companies build and deploy their own AI models. Many AWS customers want to build their generative AI capabilities and develop their own large language models, LLMs, so they can grow their businesses even more and improve their efficiencies. But the biggest hurdle is cost. It's very expensive and time-consuming to build generative AI applications and capabilities. Typically, you will need to invest millions or even billions in AI hardware and AI software if you want to build your own large language models and your own generative AI capabilities. For example, each NVIDIA H100 AI GPU can easily cost over $40,000 in the secondary market, and you will need thousands of NVIDIA H100 AI GPUs or the last gen A100 AI GPUs to train your large language models. Most companies and organizations do not have the money to invest millions in AI hardware and AI software upfront, so they have to rely on Amazon AWS and the largest cloud providers such as Microsoft Azure, Google Cloud, and Oracle Cloud. AWS customers can pay as they go. They only pay based on how much compute, storage, cloud capacity, and networking capacity they use to train their AI models. This is why I think Amazon will continue to benefit from the large demand for generative AI. I think many AWS customers will want to build and deploy their AI models using AWS instead of investing millions upfront to buy AI chips from NVIDIA. AWS has another competitive advantage. Amazon makes its own custom AI chips called Trainium for AI training and Inferentia for AI inference. Amazon also buys AI chips from NVIDIA. I think these are a competitive advantage for Amazon because many AWS customers do not have access to NVIDIA's top-end AI chips. As of now, there's a huge shortage of AI chips. NVIDIA is the only company in the world that makes the most powerful AI chips for data centers. And it's very expensive to buy AI chips from NVIDIA. So instead of waiting for NVIDIA to have more AI chips available, a good alternative is to use Amazon's custom AI chips and AI software to train AI models. So this will likely drive AWS revenue growth going forward. I want to show you these statistics here so you will know Amazon's AWS total addressable market going forward. AWS is the largest hyperscale cloud provider in the world and has slightly over 30% of the cloud infrastructure market. Amazon dominates in both infrastructure as a service (IaaS) and platform as a service (PaaS) markets. As I talked about earlier, I believe AI as a service is becoming the next biggest growth driver for AWS going forward because of the large demand for generative AI and other AI workloads we have not seen yet. AWS's closest competitors are Microsoft Azure with a market share of 22% and Google Cloud with a market share of 11%. If you compare AWS to Microsoft Azure and Google Cloud, AWS is essentially the size of Microsoft Azure and Google Cloud combined. According to Synergy Research Group, Amazon AWS is the market leader in the cloud infrastructure market, which includes infrastructure as a service, platform as a service, and hosted private cloud. Amazon AWS has been maintaining the largest market share, that's around 32% to 34% for many years already. This based on what I know. AWS is far ahead of competitors in almost every area in infrastructure as a service and platform as a service. AWS has the biggest scale in cloud computing, a huge cost advantage, and the largest ecosystem in the cloud infrastructure market. AWS is leading in many areas such as compute, networking, storage, database, data solutions, machine learning, and many AI workloads. All these things combined create a very large network effect that encourages more organizations to migrate their IT infrastructure to AWS. All these things combined also create very high switching costs for AWS customers once they start using AWS services. Based on what I know, it's almost impossible for competitors to compete with AWS in terms of scale, cost advantage, and ecosystem. It's very costly and time-consuming to build the largest cloud business that supports millions of enterprises, businesses, and government agencies around the world. AWS is already the largest cloud computing ecosystem in the world and has most developers and companies supporting it. Once you start using AWS, it's very hard to leave AWS ecosystem, and it's very costly to switch to another cloud computing platform. This is why Amazon AWS has been able to maintain the largest market share in the cloud infrastructure market for many years. According to this market research report, Gartner forecasts that the worldwide public cloud end user spending will reach nearly $600 billion in 2023 and $724 billion in 2024. The biggest public cloud spending is expected to be platform as a service, software as a service, and infrastructure as a service. AWS is the market leader in both infrastructure as a service and platform as a service. So this expected cloud spending growth will likely benefit AWS going forward. Here's another market forecast. It shows the expected growth rates for public cloud spending going forward. According to IDC, worldwide spending on public cloud services is forecast to reach $1.35 trillion in 2027. Although annual spending growth is expected to slow slightly over the 2023 to 2027 forecast period, the market is forecast to achieve a 5-year compound annual growth rate (CAGR) of 19.9%. This is my prediction here. If IDC's cloud spending forecast is correct, I think AWS revenue growth will accelerate again over the next 5 years and achieve a CAGR between 10% and 20% from 2023 to 2027. Again, I think generative AI and other forms of AI workloads will be the biggest growth driver for AWS going forward. Other than AWS, I believe Amazon's second biggest growth driver is its advertising business, which is driven by Amazon's marketplace business. Here's why. Every quarter, Amazon makes a lot of money by selling ads to third-party sellers. Here, you can see that both third-party seller services and advertising business have been growing at double-digit growth rates that are higher than most other businesses. I believe this trend will continue for these reasons. First, more buyers are shopping on Amazon because of product selection, prices, and convenience. You can find almost anything on Amazon. Prices are usually very competitive on Amazon. More importantly, Amazon has the best and fastest shipping services, especially for Prime members. This is why most people, at least in North America, like to shop on Amazon first before shopping on other online stores and other online marketplaces. Second, since Amazon has the biggest customer base and attracts the most buyers, more third-party sellers are selling their products on Amazon every year. And third, Amazon will continue to sell more ads to third-party sellers to help them increase their sales. So all these things combined create a huge flywheel effect for Amazon. More buyers attract more third-party sellers, which attracts more ad revenues for Amazon. Here's another important part. Amazon does not tell us its advertising business operating margin. However, according to Morningstar, Amazon's advertising business operating margin is estimated to be over 30%. This is similar to Facebook's operating margin when Facebook had a similarly sized ad business before. If this operating margin estimate is correct, We can expect Amazon's ad business to become even more profitable over time as the business scales. At the time of making this video, Amazon's digital advertising business is already the third largest in the US, just right behind Meta and Alphabet. According to this forecast, Amazon's ad business is expected to capture more revenue shares going forward because of the flywheel effect I talked about earlier. Since more third-party sellers are selling their products on Amazon, many of them will likely buy more Amazon ads to increase their sales. I want to show you Amazon's expected growth rates going forward. According to Seeking Alpha, Amazon's consensus revenue is expected to grow between 10% and 12% each year over the next 5 years. I think these growth rates are reasonable, given that Amazon is much larger than before. If you look at Amazon's historical growth rates here, you can see that Amazon's revenue was growing much faster before when Amazon was much smaller. This is my prediction. I believe Amazon's total revenue will eventually reach over $1 trillion over the next 10 years because of Amazon's e-commerce business and the growth drivers I talked about earlier. In terms of EPS estimates, Amazon's EPS is expected to grow much faster than its revenue growth going forward because Amazon's operating margin is expected to improve over time. I want to show you how to calculate Amazon stock's intrinsic value here so you will know when Amazon stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. First, I'm not using a DCF model to estimate Amazon's intrinsic value because Amazon's free cash flow fluctuates a lot. Amazon does not have very consistent free cash flows yet. I'm using a simplified sum of the parts valuation model here since Amazon has these 6 major business segments. Let's go over these business segments here. For Amazon's online stores and third-party seller services, I'm using Walmart and eBay as comparable companies here because they are Amazon's biggest competitors in online stores and on online marketplaces. Based on an average price to sales of 1.87, I believe this business intrinsic value should be around $651 billion. For Amazon's physical stores, I'm using Walmart and Kroger as comparable companies here because they are Amazon's biggest competitors in grocery stores in the US. Based on an average price to sales of 0.43, I believe this business intrinsic value should be around $8 billion. This assumes Amazon has lost a lot of money buying out Whole Foods more than 5 years ago. For Amazon subscription services, which include Amazon Prime, I'm using Netflix and Spotify as comparable companies here because they are Amazon's biggest competitors in online movie and music subscriptions. Based on an average price to sales of 5.36, I believe this business intrinsic value should be around $202 billion. For Amazon's advertising business, I'm using Alphabet and Meta as comparable companies here because they are Amazon's biggest competitors in online digital ads. Based on an average price to sales of 6.13, I believe this business intrinsic value should be around $253 billion. For AWS, I'm using Microsoft and Oracle as comparable companies here because they are Amazon's biggest competitors in the cloud computing business. Based on an average price to sales of 7.2, I believe this business intrinsic value should be around $615 billion. Once we add all the businesses together, Amazon's intrinsic value should be around $1.65 trillion for the entire company, or around $158 per share. I also used the forward price to sales valuation model here to estimate Amazon's intrinsic value, which should be around $1.63 trillion for the entire company, or around $156 per share. If we take the average of both valuation models here, I believe Amazon's intrinsic value should be around $157 per share. Just to compare, Morningstar gave Amazon a slightly lower fair value of $150 per share. This means I believe Amazon is likely undervalued at the time making this video. So will I buy Amazon stock? Yes, I will buy more Amazon shares going forward because I like Amazon's businesses, especially AWS, online marketplace, third-party seller services, and advertising business. I also like that Amazon has very large economic moats in most of its businesses. I think Amazon will benefit a lot from the large demand for generative AI and AI as a service going forward. This is one of my portfolios here. I also have other portfolios with almost the same stocks and the same investment strategy. I already have Amazon here. I did sell some Amazon shares before and took some gains. Right now, this portfolio has been down recently mainly because of the current macro headwinds, such as high inflation, high interest rates that will last until at least 2024, and geopolitical tensions between China and the US that are affecting many semiconductor companies. The Fed is planning to hold interest rates high for a longer period of time until at least 2024. I'm not too worried about all these macro headwinds because many of these headwinds will eventually ease once inflation starts coming down significantly toward the 2% target. I have invested in some of the best companies that are the best and most competitive in their industries. For example, I've invested in Apple, Alphabet, Microsoft, Amazon, Visa, MasterCard, Tesla, and Adobe. Recently, I started buying back very small positions in Meta and Nvidia again. If the market dips more, I will buy more of the best companies whenever they're undervalued. I believe they will outperform the S&P 500 over the long run because they have the best products and services, the largest economic moats, great management, great long-term prospects, increasing earnings, and increasing free cash flows over time. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Research channel, and I will see you in the next video.